Imagine standing on the beach. The sun is out, the waves are gentle, the air feels still. But out in the distance, something is shifting. A ripple, then a swell, then a wall of water. This is what every smart investor feels right now. We're joined again by Westpac Chief Economist Kelly Ekholm, the man who sees the swell before the surge.
Financial freedom faster. Financial freedom faster.
If you like watching other people make money, keep scrolling. But if you're the kind of person who wants the edge, the insight before the headlines, hit subscribe. Because in 2025, more New Zealand investors get their housing intel from this show than anywhere else on YouTube. The smart ones already know, and now you do too. Kelly, has the Reserve Bank already quietly signalled a 2025 rate cut, even if they haven't said it out loud?
Well, certainly in their last forecast that they signalled, they thought they had at least one to go. So if we look closely into the bowels of the numbers that they published back in May, suggested that the OCR would be at 3% by the end of this year, and there was perhaps maybe half of a chance of something else next year, depending on events.
And what's the RBNZ's likely mindset at the moment? They're probably stuck 50-50 on what to do, or you think they're going to swing one way or the other?
I think for right now, they're probably comfortable in doing nothing, because when you're only talking about one, possibly two more cuts to go, then there's no urgency to do them cut every meeting. The idea that you might look at it every couple of meetings, particularly when they do their bigger monetary policy statements, and those are due in August and November for the rest of this year. Those are the obvious dates at which they could do a policy move, because they can fully review all their forecasts and justify what they're doing at that point.
And what key points should property investors be looking at, and what are they tracking? You put your property investor hat on. What should we be looking at over and above just the OCR?
Yeah, so over and above the OCR, from a property perspective, I think people will be interested in what's going on with rents, because that's part of the investment side of the occasion, of the equation. And rents themselves are obviously still running at pretty low levels right now. On the other side, I think they'll be looking at the trend in prices. We have seen that house prices have been rising gently, I think, in the first 4 or 5 months of this year. They didn't rise as much in May as we expected might have been the case. And perhaps there's an element of a little bit of uncertainty creeping into buyers that has meant that the increase in house prices isn't picking up quite as strongly as what you might have hoped, given where interest rates would be. But I would say the big thing that should be high on the mind of investors, and something you probably want to get in front of, is what's going to happen to the labour market. Because I think the strength of the labour market is going to be an important barometer in terms of what households actually do with respect to spending and investing. Once we get through the back part of this year, and ultimately the path for the economy and probably for real estate after then.
And what happens if labour, like the unemployment rate's sitting over 5%, you're projecting that to drop? What happens if it doesn't? What happens if the unemployment rate just stays at that 5% rate, even higher for a long period of time?
So the baseline forecast right now is that we do get a further increase in the unemployment rate to 5.3%. It stays there for about 6 months, and then we start to see it move down a little bit right at the end of this year, but it really doesn't do most of its moving down until we get into the first half of 2026. So if that sort of scenario happens, I mean, that's basically consistent with probably the Reserve Bank's view of how the world's going to unfold. And as a result, they would say in that world that maybe another rate cut in them, possibly another one, depending on what happens. If the unemployment rate goes a bit further than that, if it starts to head up towards, for example, 5.75% or 6%, they'll probably conclude that there's going to be room for a bit more stimulus. And that's where the door would open, I think, to, perhaps 2 or 3 more cuts, relative to, the 3.25% level that we're at today.
And how do we balance that with the expectations around inflation that's the expectations there were inflation was under control, and now seems like that might not be the case.
Yeah, I mean, it's probably under control, but the questions are really around how long it stays right up at the top end of the Reserve Bank's 1 to 3% target range, and what's a reasonable expectation for where it's going to settle as we go through 2026. Most forecasters had to revise up their forecast for inflation in the last 6 weeks or so, and I think that'll be something that the Reserve Bank talks a bit about when they give us their statement in July. They won't be particularly comfortable with forecasts of inflation that are basically either at or perhaps even slightly above 3%. They won't be very comfortable with the idea that even if they get to the end of this year, if our forecasts are correct, that they'll still be sitting at 2.9%. And whilst given where the economy is right now, they're probably not really thinking about putting interest rates up. It is certainly the sort of thing that might lead them to just sit on their hands and wait a bit to see when that peak is going to be, how high it's going to be, and then how quickly is inflation going to move back to 2%.
And should we be concerned about falling building consent numbers? And I did notice the gap between consents and actually, the builds completed was quite big recently.
I don't think we are that concerned about that. The broad trend in consents has been flat now for about 9 months. We actually had a decent rise in consents in the May month when that data came out earlier this week. I think it went up about 10%, but I wouldn't say that that's the resumption of a new strongly growing trend. What we tend to find with that data is it's very volatile on a month-to-month basis. Given house prices have basically been going sideways to slightly up for the last 6 months or so, that probably tells us that we should expect consents to be fairly stable as well. It's really probably towards the end of this year that we might expect that trend to improve.
And what are the insights from the consumer confidence surveys coming out recently?
Consumer is actually looking a little bit more resilient than they looked like perhaps a couple of months ago when the scariest headlines about the global trade situation were echoing around. In general, consumer confidence is lower than we would like. We would like to see consumer confidence stronger, and I think business would like to see it stronger as well, because that would give them a better basis for expecting stronger business activity. But it is still generally improving, and you should expect it to improve given how far interest rates have fallen in the last 9 months or so.
And our primary sector exports just holding the country together. I saw around 16% increase year over year.
Yeah, it remains the strong point. There has been some volatility in dairy prices in the last few weeks, and we saw a 5% fall in dairy prices at the auction, which was held this week, which probably just reverses some equally large rises we saw perhaps about a month or so ago. More generally, though, I mean, if we look outside dairy to the meat sector, for example, those prices are still rising quite strongly. The beef sector in particular seems quite positive. The other thing I'll say there is that at this time of year, we tend to see the seasonal peak in credit demand from farmers because they have this concept of moving day, where basically farmers tend to sell their properties, share milkers, move farms. And what we actually saw in the May month was the biggest drawdown of credit from the dairy sector that we'd seen since those statistics started to get compiled in 2017. And my colleagues in the agri area of the bank tell me that what's driven that is just increased confidence amongst farmers to get on and invest and do things that they've maybe been thinking about for a little while now, but now they just feel, yep, it's the right environment.
Well, that's really propping up the South Island property market and especially some of the rural areas. Where are you putting your attention and finding areas of interest in house price increases?
That's right. We continue to see that relative outperformance in the parts of the country that are most leveraged to these sorts of trends. So, for example, Southland, Canterbury, Actually, I think even Waikato kind of like prices tended to outperform what was generally a pretty static number when we saw the totality numbers come out just this morning, actually, for around the country.
And in terms of how the New Zealand economy at large is going, GDP growth within kind of expectations or slowing down?
We think that probably GDP won't be as strong as it was in the first quarter, where we got that pleasant positive surprise of 0.8% growth for Q1. We've revised down our Q2 forecast to 0.4%. And that reflects that we have seen some weaker data in some of the higher frequency indicators as we've gone through May. Some of that, I think, is related to some of the negative trade and perhaps some of the kind of war news in the Middle East that might have just dampened sentiment a bit. So that might bounce back a bit as we go through the next couple of months. But it doesn't seem particularly like a good bet to say that we're going to get 0.8% again in the second quarter. I will say that the Reserve Bank kind of anticipated that there'd be a bit of a pullback in growth for a couple of quarters. So their June and September quarter forecasts for GDP quite a bit lower than ours, and probably our numbers are coming a little bit closer to theirs now.
Well, you've certainly worked abroad and you understand how the markets are working in the US and Asia, and you've seen it all play out internationally. How is what's going on across the world impacting the New Zealand kind of housing and investment behavior? How do you summarize what goes on globally to advise Kiwi investors on how to think?
I think that there's a lot of uncertainty out there, which probably is leading some investors to hold back a little bit on things that they otherwise would do. But I think the general view I have on the economy is that while those commodity prices remain quite strong, and while those interest rates remain as low as they are, that the uncertainty associated with those international impacts will fade. And we should see strength resume, as you would expect, given those underlying kind of more structural drivers. In terms of the global trade environment, I think things have looked quite a lot more encouraging as we've gone on. Donald Trump has been making deals now. He's announced that if countries are transshipping goods from China through other countries, that they'll be subject to a 40% tariff, which is obviously a bit higher, but that's a long way south of the 140% tariff that he was talking about on China back in April. So what it rather looks like to me is that, with a few exceptions, countries are starting to fall into line here, deals are being done, and that means uncertainty will be reduced. There's certainly going to be quite a few tariffs out there that everyone's going to have to pay, and probably US inflation will be higher for a while as that passes through to them. But for the rest of us, the big issue was really the uncertainty about how this is all going to play out, whether countries were going to fight, whether there was going to be retaliation that just made it worse for everybody. And I would say that a lot of those concerns are a lot lower now than they were sort of 6 weeks or 2 months ago. That's good, I think, for uncertainty.
There's still a lot of people willing and wanting to borrow money to invest in their business and buy and invest in properties. Surely you're seeing that Westpac's seeing demand for mortgages and business borrowing.
Yeah, there's still quite strong mortgage demand. It does depend on the sector. So actually what we see is that investors are really leading the way there in terms of the demand for credit. And I think that makes a lot of sense when I look at the last time interest rates were started to be cut in 2019, where as those interest rates fell, the investors responded by going, well, this is actually increasingly looking like a good bet. And they started to draw down credit so that they could invest. So that's a positive factor. The thing that I think probably holds back the market more generally is that uncertainty. And the weak spot for credit in the economy right now is in the business sector, where they're not really drawing down a significant amount of credit right now. And I think that perhaps reflects some of the negative sentiment we see in the business surveys in the last couple of months, where businesses are just saying, well, right in the here and now, things just still look a bit soft, and therefore I'm just going to stay a bit cautious for a while, even though I think if I look forward, say 6 or 12 months, that things will look better.
Oh, we should all be praying for business owners to feel confident to spend money. Otherwise, we'll be in more trouble. Appreciate your insights today, Kelly, and suggest anybody want deeper analysis to download the economic reports on the Westpac website. And we'll catch up again soon.
Thank you very much.
Just a reminder, your competition has already hit subscribe on the fastest growing property investment channel in New Zealand. They're getting the tips, tricks, and the juicy insights before you've even finished your coffee. They're buying, building, banking profits while you're still sitting there thinking, should I click the button? Come on, be clever, hit subscribe, or don't, and enjoy watching everyone else get rich.